Is there anything that you see as attractive at the moment? Is there anything that actually we should be looking at to buy?
Well, our preference right now goes to investment grade credit. We are a long-term investor, and historically the default in that space is extremely low. And given that the policy focus from governments, from central banks, has been to support the corporate sector, we like investment grade credit. Of course, there is a rating migration risk. We will see more fallen angels, more companies going from BBB to high yield, and that's a risk that we want to manage. And we put a lot of focus, a lot of effort on bottom-up credit research. But this is an area that we like right now. On equities, we're a bit more cautious, with a clear preference on defensive sectors, given that we've seen already quite a strong recovery. There's been clearly a positive impact from the slowdown in the coronavirus contagion, a positive impact to the very strong policy response. But now that the drawdown in U.S. equities has been more than half, we're taking a fairly cautious stand there with, again, a preference for defensive sectors in the equity space.